Hey guys, welcome back to my YouTube channel. This video is for your trading psychology, which is 80% of the game. In this video, I used ICT's voice from his Twitter space, which is really useful for your trading. So watch the full video.
I have other tricks. I got all kinds of stuff. I got weapons you ain't never seen before. It's a technique for high frequency trading. Algorithms use that as an entry model. Boom, 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 firing in there real quick, right? If you know the market's likely to go 38.64, and you know that the likelihood is everybody's going to be squeezed out of their short positions because the algorithm is going to start repricing higher, 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 spooling towards those buy-sell liquidity pools that I've outlined on the chart at 54, if my memory serves incorrect, and then up at 64. Okay, so the initial buy-side liquidity, that was the first draw. And what I'm waiting for is I want to see speed. You'll see me say in there, I type it out and say, okay, you're going to start seeing large range candles and the speed. Study the speed. You're going to hear me talk about this in the live streams. You're looking for that. That is a signature. What does that mean? It's something that you should be seeing in price. If it's not doing that, you're probably offside or it's going to consolidate longer. And depending upon the time of day, if you're going into lunch, you want to cut bait. Don't trade. But ICT, we watched you trade in New York. That's me. I'm trading outside of what I've already been willing to share to you. I have other tricks and shit. I got all kinds of stuff. I got weapons you ain't never seen before, and I'm not going to share them all. I'm sorry. You can't have all my tech. I'm sorry. You're not entitled to it. I'm not teaching everything I know. But what I am teaching, what I've already taught, is plenty. So if you're expecting speed in the direction of that 38.64 level, what would you want to see? A real quick sudden move up, just like that, right? Now, for the gentlemen out here to have, and maybe some of you ladies too that are hot riders, if you have a fast car, and maybe you just got your license recently and you took your dad's car out and you want to burn some rubber, knowing damn well you shouldn't be doing it. But when you sit there and you neutral drop your car, I'm not saying that's a good thing, but some people do it, you burn out and you make a skid mark as the car takes off real quick. Okay. You want to see that in price, that burnout, that sudden run. ProCharge Mopar knows exactly what I'm talking about right now. He's already smiling because he's now getting it. That runaway, real quick move, when you're expecting speed to come into the marketplace, that displacement, you want to see it stay open. You do not want to see it come back down in. When you see that, that is a breakaway gap. When we had markets that were not 24 hours, okay, like forex is 24 hours, and stock indices are not 24 hours, but there's a small window of time where 1 hour it's not trading. But you have a gap opening. That gap opening sometimes is useful. But when we didn't have electronic trading, there was always gap openings. You had overnight gap risk is what it was. Gap risk is always an issue. You didn't know where your currency futures were going to open up. You didn't know, where this shit was going to open up unless you were monitoring overnight, in the Globex, what was going on. And Globex is like the overnight session. So I'm trying to teach you to anticipate when you're expecting a market move to go a one direction, higher or lower, based on your bias. The narrative was, I left you in the morning session, 38.64, note that relative equal high, because that's where we're heading. 3 o'clock hour starts. We are finding real support at fair value gap discount lows. And we create a fair value gap on the 1 minute chart. 11 minutes, 12 minutes, and 13 minutes, respectively, on a 1 minute chart on ES. That fair value gap is drawn out for you in the recording. It's a little light blue one. I move my stop up just below the low of the 311 to 313 fair value gap. I'm just below that, one tick. And the whole time I'm recording this, I'm thinking to myself, they're going to shit themselves when they see this. And to prove it, I went in and I bought it again when it went down and touched the bottom of the fair value gap. Why didn't it go outside of that? That's what you're wondering, right? Why didn't it go outside that? Because it had already tapped the low of the fair value gap on the hourly, the 15, and the 1 minute fair value gap, it had already touched it twice perfectly. And we were running short on time. We were running down the clock until 4 o'clock. Yes, it trades a little bit past that. That's not my point. The volume that's going to come in on market on close orders is 3:40 to 4 o'clock. That little window right there. Okay. Days that close with liquidity pools that have not been breached or engaged yet, you'll find that that little segment of time is a sweet spot for a model all in of itself. Who wouldn't want 20 handles? I pulled it out like it was nothing yesterday. 22 handles for the people that made fun of just 5 handles. It's 87 ticks per contract. So how do I know it's going to stay open? Just like a burnout. Okay, think about that funny car, that stock car that's real fast. And when that green light go, it takes off. It's going up the road. It's gone. You don't want to see it go back to the starting line. You don't want to see it do that. You want to see it just keep on hauling ass. So when you're expecting price to deliver and run towards a goal and you have a limited time, what would that look like? Well, if you're trading in the 10 o'clock hour, 10 o'clock to 10:30, remember 11 to noon is when things start creating the consolidation for lunch. Not that it will, but my expectation is things start to slow down going into lunch, and then lunch usually has a retracement, goes for the liquidity, during that hour or prior to it, and then it's either going to continue or reverse or stay consolidation, and that's a discussion entirely for 2023 because we will talk about that. But when I look at the market and I'm expecting fair value gap to stay open, I'm anticipating more volatility and velocity in the direction of that run. And see, the things that I saw with Chris Laurie's stuff, he never had that, never talked about that. Nobody else has ever talked about it either. I wish there was other books or authors and things that would talk about these things, because I could save myself a lot of aggravation, because I know it's going to take lecture and lecture and lecture doing this and also show it to you live. I have no problem doing that. But most of you that keep asking the same questions, even when I give you what I believe is the best I can articulate, it's frustrating for me because you're not going to connect with it because you haven't done other things. And for folks that have been with me for a while, the analogy of a burnout, okay, when the car takes off and skids its wheels as it's going real fast forward, that run up that creates that big candle one way, that's like that. Like that, it's a car. It's just finally been allowed to go quick, and it peels off real quick. Those instances when you're expecting the market to run hard, you want to see that stay open. Now, the question is going to be is, okay, well, ICT, have you ever had that instance where you felt it was likely to do that and it went back into it? Yes. If it does, I'm going to buy it. In fact, if you watch the video, I'm waiting because there was one time where I thought it was going to dip in there, and then that would have been institutional order flow entry drill. Doesn't change the bias. It doesn't change the fact that it's not going to go higher. It's going to go higher. It's just giving me an opportunity to buy it at a slightly lower discount. But in my logic is it will stay open. It will not completely close. It might go down just below the top of the fair value gap. That's institutional order flow entry drill. It's a technique for high frequency trading. Algorithms use that as an entry model. Boom, 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 firing in there real quick. That's the other algorithm. The algorithm that is the price engine that makes price go where it's going to go, and no buying and selling pressures doing anything about it. Nothing. How many contracts cause the S&P to move 5 handles? How many contracts does it take to do that? Think about that logic for a second. How many contracts, how much volume does it take to move the S&P 5 handles? Oh, shit. Never thought about things like that, did you? But the books don't talk about it either, so it's never come up in question, right? You only need one contract to book price. One contract, one contract, one contract. It does not matter. That's why when you see charts that used to track volume when we were a futures trader, market keeps going up. The volume bars keep going down. What the hell's going on? Volume ain't it, folks. That's not how you use volume. That's not how you use volume. You use volume in the sense that, hey, order flow is going to increase. The velocity of orders coming in and traders wanting to do something, you can time that. You can time it. Certain times of the day, it's like, well, at the opening, there's a lot of volatility, right? And that last 20-minute period of the last hour trading, you can plan on it again. So if you have untapped liquidity pools that are just so obvious, you're sitting right there, that last 20 minutes of trading, that's how you do it. You aim for that. Now, what happens if you get it wrong, if it doesn't move in your favor and it stops you out or doesn't move? That's trading, folks. That's just the way it is. You have to have a catalyst for why you're going to go into the marketplace and do whatever it is you're trying to do. If you're going to be a buyer, what makes that or constitutes a reason for you to be a buyer? There has to be some kind of logic that you're following behind you're exercising and inviting risk. You can't just, well, I feel like doing something, I got time. There has to be a logic as to why you're expecting it to do it. So, in short answer, when I'm anticipating gaps to stay open, I have already framed out the logic that it should be a market that should be moving quick. And if I see that, then I know I can do what? I can trust that my liquidity or inefficiency I'm aiming for will be traded to. That's why you see the confidence in my texts that people think it's cherry picked or that I'm adding it after the video's been done. There's no way you can explain all that shit. Okay. It's being typed through TradingView real time. And when I type this stuff, if it was something added on after the fact, because I can take annotations and type it into a video on Camtasia. But when I add it to that, like for instance, look at my watermark, innercircletrader.com. Okay. That stays in one place. That's how you know it's Camtasia. That's added after the fact. That's an after recording annotation. In TradingView, do this and test it for yourself on Tuesday when the markets are open again. Go in there and type out something with TradingView on a 1-minute chart and then watch it. The annotations tick to the left when there's a new candle opening up. You're telling me that I have that much editing ability that I can go in there and I can fucking make 20 different things on my annotations all move in synchronicity? The fuck out of here, man. You're giving me way too much fucking credit for shit that ain't impossible. Just accept the fact that I can do this and you're going to see me do it anyway. You're going to be able to learn how to do this. Okay. Stop making excuses for holding on to dumb shit that doesn't work well for you. Okay. Or maybe you're struggling or you got to worship your hero or he's going to kick you out of your service or whatever. Fuck it. Get away from those type of people. If somebody's telling you, you better rep me in my community or you're getting kicked out of here, get the fuck away from that person. That's not a mentor. That's a nut job. Okay. You don't have to pay anything to be here.
I hope you guys like this video, so don't forget to hit that subscribe button and check out our technical analysis video also.